Hello, everybody. My name is Jesse Day, and this is the VRIC channel. We are continuing along with interviews every Friday, and the next Vancouver Resource Investment Conference is going to be coming up January 21st and 22nd, 2024. We're already counting down to that. As soon as the tickets become available, I'll let you know, so definitely stay tuned for that. And today's guest is the Chief Trading Strategist and Editor of Gold Charts R Us, Mr. Omar Ayales. Welcome to the program.
Thank you, Jesse. Great to be here.
Great to have you here. So, I want to start with the news of the day. Everybody's talking about it, the collapse of Silicon Valley Bank and Signature Bank, and perhaps weakness in the overall banking sector that's now included Credit Suisse, although now the Swiss National Bank has said it would provide a liquidity backstop. So, for the time being, that situation looks a little bit better. We've heard all sorts of takes on the situation. Some people are saying this is a systemic risk, it could cause contagion. Other people are saying, no, this is more contained and really nothing to worry about, and everywhere in between. So I'm wondering what your perspective is. What is it that caused all this? How serious is it, and how worried should people be?
Well, I think first of all, Jesse, whenever a bank goes under, is never a good thing. Okay, and the reason is that the reality is that the banking system is so intertwined and so levered, with each other, with different institutions, and that eventually any type of risk at any potential moment could be systemic, just because of how everything is interconnected. However, in this particular case, and something that we've been telling my subscribers is, you know, like uh, um, uh, the Swiss Valley Bank is not Lehman Brothers, right? SVB is not Lehman at all, and the reason is because really SVB really had a strong exposure to Silicon Valley, okay, which basically a lot of tech, that has been, just have been taking a hammer, the past, year or so, and it's just been that tough for that sector, and some lack of risk management, that you can probably have been reading in the news here and there, and just too much exposure to that particular sector that honestly has been doing great for the past almost 15 years, and now it's actually turning for the worst, and some of the stuff that we're seeing is, tech could actually be in for, a deeper correction as it relates to the rest of the market, the industrials and other sectors. One of the things that could be happening. So when you have tech companies that have very small profit margins, where everybody's kind of competing to the ground in how much you can offer for less, and in a rising interest rate environment, that's just, the recipe for calamity. So it's very unlikely that any especially startup, with that hike in cost, could actually stay alive. So it's actually, I would have expected to actually maybe see more of these regional banks that have exposure to this sector. And right now we see SVB as the headliner, and yes, Credit Suisse, of course, Credit Suisse is a giant. But Credit Suisse has been having its own problems for a very long time. Like right now, that the fact that this is happening with SVB, and it's coming back into the headline news, and in a way trying to make it seem like it's systemic. I honestly do not think so. Like they've had their own issues for longer periods of time, and of course, like them being, the player that they are, it's not surprising that the Swiss National Bank is coming up, to pick up the tab. They're not going to let, that giant just go like away that easy. I do believe that a lot of the news was an orchestrated attack, and most likely to see maybe like a pullback in stocks. And like the way that I'm seeing it is actually it's a great opportunity to buy.
Very interesting. So I want to know how much, in your opinion, how much of this blame for this occurring lies at the feet of the Fed and this quick rate of interest rate increases, the fact that they've increased so much, so fast, almost unprecedented throughout their history. Is that at the core of it the main problem that caused all of this?
Well, look, Jesse, it could have it could have a little bit, like I was saying, like in the end, when you have, a hike in interest rates, you are increasing the cost of things overall, the financial cost. And, a lot of these, companies, like, are levered and, and like I was saying, with low profit margins, with, low incomes, like an increasing cost, like it's just a tight squeeze there. However, I think that is not necessary. That's more due to, the small margins that these companies operate on rather than maybe the actual hike in interest rates. If you actually see, yes, the interest rates have been rising, and yeah, maybe like from zero to what is it? What are we now? 425, 450. People are now five. Like but at the end, and the guidance is being increased as well. But at the end of the day, it's still below the cost of inflation. Real rates are still negative. Okay, you see other things that have been going up, like for example, wages. You see, everything has been coming up like together, and so I don't, I don't really see that as a situation where there's an imbalance that could cause, such a calamity, something to happen where a bank would actually go under, because really everything has been moving in unison. Right now, what that means for me is that really the economy, the U.S. economy, despite the gloom and doomers, I think is actually doing great. And I think that's a testament to that. The hike in rates actually is, that's what it's saying. I don't necessarily now. Of course, I think like everything. I think like I was saying before with the SVB, like I'm not sure if this was just basically an attack, some short seller, some publicity is being thrown out there, because like this bull market is very much a hated bull market, and people have been wanting for it to fall, correct, a recession, all these things that are being said, and at the end of the day, the data still comes out very strong. And when you have strong inflation, strong unemployment, numbers, rising employment numbers, which haven't happened in a long time, like the participation rate, and you see a dynamic economy, you can't really think that like the risk that SVB went through could be systemic, because you have so many other banks that have so much exposure to so many other sectors of the economy that are actually performing and doing well, and that are fueling these numbers that are seeing in the economic data, the stuff that Joe Powell is seeing. So I don't really think, I mean, it would be a little bit unfair. I mean, when will the adjustment in rates affect business to a point where it could push things into like a recession? I think is yet to be seen. I think it's going to really depend on also the economic activity. I think it's going to be regarding rising prices. You see the Fed right now. You see Joe Powell. Their eye is on the consumer price data, and the unemployment and the low unemployment. Like a regional bank going under is not gonna, I mean, shouldn't derail any guidance, to be honest. I think that actually, and it's maybe likely that who knows what's going to happen when he announces whatever he announces, but I do believe that he will announce a continued increase in rates. And look, Jesse, it shouldn't be that crazy. Like if you really see it, you don't really have to see what have to like be guessing, second guessing the Fed. You just have to look at the 2-year yield. If you look at the yield of the 2-year Treasury of a U.S. 2-year Treasury, it usually tracks that, and that is basically the reason why that's important, is because that yield is defined by the markets. It's not imposed by the Fed, as the Fed funds rate is. So when you see the Fed basically following that, what it is doing is following the market. So if the market is saying that a 2-year yield is at 5%, that's what the market is saying. It's not just being imposed by the Fed necessarily. So that tells me that the market feels that it's an appropriate rate. So how, could businesses be really being affected that much on a rate that most market participants are, okay with? It's unlikely. So I do think it's more of a situation related to SVB, to the tech industry, going back to that. And I think that's why that situation will be contained.
Well, great breakdown of that. Now let's shift focus to China for a moment, as you mentioned it in your latest newsletter at Gold Charts or Us. So give us your view on how the reopening of China, and particularly its demand on commodities, could affect the market and the global economy.
Well, China is the world's consumer. It buys basically 50% of global resources and commodities. That's huge. Okay, so like when you have this huge buyer of everything, having been asleep for over 1,000 days, 3 years since the pandemic shut down, and now it's suddenly, for the first time, it hadn't budged, it hadn't announced, just out of one day to the next, you know what, we're reopening to the world and this is what's happening. That type of policy shift, comes, probably because they needed it. They can't be locked down forever. China needs the world as much as the world needs China, and that's just a reality. And maybe you're not going to see out of China what happened in the US and maybe even in Canada with the different, stimulus money. But you are going to see, a business being stimulated by the government, which is how they stimulate their economy, right? They stimulate businesses directly. They become big buyers and then big hoarders. And China grew at a 2.9% last year, which is the lowest in decades. And this year, 2023, the forecast is to go back to a 5%, which would be the lowest guidance in decades as well. So even if they are able to reach that 5% target, which is, what had been very normal until, over the past 10 years and higher, that's basically double the growth it had experienced last year. Even if there's a recession in the Western world, that should be enough buying power to keep upward pressure on prices, which is not necessarily a good thing. Like if we have the Fed on one side, pushing for a recession, wanting more slowdown, wanting unemployment, and on the other hand, you have, big players in international order, coming to the plate to buy, putting, keeping pressure higher on prices. That's just a recipe for stagflation. And, again, not necessarily a great thing with a great outcome for the Western world, but nonetheless, that is very much what seems like to happen. Unless there is no recession, and basically the Western world continues to fire on all cylinders, which would even be probably even more inflation, even more. Yeah. We kind of need this little slowdown from the Western world in order to allow for the rest of the world to catch up a little bit, in a way.
Well, I want to touch on something else you said in the newsletter, which was the war in Ukraine is reshaping the geopolitical landscape through renewed global alliances, therefore redrafting globalization, an issue that could make inflation structural, fueling higher prices for longer. So could you break that down for us and walk us through how this conflict could create structural inflation?
Absolutely. And look, the reason is this, Jesse. The post-World War economy, okay, was basically based on, opening up globalization. The idea being that a globalized world will be less susceptible to individual catastrophes worldwide, individually, wherever in the planet, okay? For 50, 60, 70 years later, okay, we're in today's world, and we have realized that it is very nice to think that I will be able to buy whatever I buy at the cheapest price possible because I'm able to source different resources and different labor from different parts of the world that will allow me to get the lowest price possible. But the reality today, the Russian-Ukrainian situation, okay, basically is fracturing the world in two, and it's between the Western world, and I don't want to say Asia, but definitely Russia, and whoever's going to be allied to Russia. Okay, and Russia being the huge producer of natural resources that it is, and just they have lots of it, lots of stuff. It's gonna, if the U.S. and the Western world say, look, Russia, we don't want to do business with you. You're an outcast. Goodbye. Like, okay, that's great, but at the end of the day, Russia is still a major player in the world. There's still a couple hundred countries, in the world. Other than that, they're going to want their cheap, oil. They're going to want their influence. They're going to want to do business with them. That they don't really care, what's happening, in the Ukrainian border. So that is going to push Russia, or has been pushing, and you've seen news about it all in different ways, pushing Russia to create basically its own platform of services so that they can operate outside of SWIFT, outside of the U.S. sphere of influence. Okay, you're seeing them, now reaching bilateral agreements in their own currencies, or in other currencies that are not the dollars, for they're not US dollars, for for natural resources and crude oil, etc., energy. That's already happening. So once we are basically deglobalizing, okay, deep globalizing. And how so? Well, because all of a sudden, if Russian energy was the cheapest energy, we can't get cheap Russian energy, and we're gonna have to ship it from here or there or whatever, and increase those costs. Well, guess what? Those costs are going to that's inflation, right? That's higher cost in fuel. That's going to translate, not only into the pump, but also to the goods and services that you buy, because everybody's going to have to pay higher gas, for example. And then that goes the same for all of other natural resources. Okay, because all of a sudden, we're not just sourcing them from the cheapest places, we're sourcing them from whoever we want to do business with. Okay, so all of a sudden, and this is where China and the US is huge, because ultimately, what the biggest loser of all of this could be China itself. Okay, because China really ultimately, yes, they're huge, but they need the US, they need the Western world. The Western world is the one who has been buying all the Chinese stuff, has made China basically who it is over the past 30 years. So the geopolitical threat that China represents the West, okay, as it's made evident by this situation, is pushing the world towards tribalism, in a way where, again, we're going to start dealing with our own friends. You know what? If I'm Europe, I'm going to buy gas from the US and from Canada, because you know what? Those guys are, we're friends. We have similar legal situations. We think the same. We know what can and cannot happen. We rely on the legal systems, and something that we can trust. I think we're going to start seeing more of that. And again, because that means convenience, and not necessarily a convenience and cost for, say, even geopolitical safety. At the end of the day, for example, like, you don't necessarily want the US, and the Western world is not going to want to depend so much, for example, on a country like China that could eventually bring the West to its knees, like Russia has tried to do with Europe. That we could be a replay of all of that altogether. Especially like because of what the importance that Taiwan represents. Like, this situation is basically, this Russian-Ukrainian situation is going to be, whatever happens here, whatever the outcome is most likely what's going to end up happening between China and Taiwan in the South China Sea. And all of that, hinges on this. And because, again, we're fractioning, we're going back to a sort of tribalism. We're going back to dealing with our friends, and not necessarily with whoever's willing to sell me at the cheapest price. Okay, that in itself could create systemic increases in prices, because, again, we're not buying based on price. We're buying based on, convenience of dealing with, friends. That's how inflation could become structured into the system. Again, globalization, low cost. Deglobalization, increase in cost.
Yeah, that makes a lot of sense. Now, you've called this situation we're in gold's perfect storm. So, what are the reasons for what you believe is a perfect setup for gold to move higher here?
Well, I mean, gold is probably, historically one of the best hedges against inflation. And, like, with everything that's happening, I do feel that we are, and look, I know I'm not necessarily, like, on the most popular camp, like at a place like the VRIC with what I'm about to say, but I am a chart reader, and I do analyze the data and look at the charts, and I try to be as objective as possible. But that back in 2022, last year, when we saw, for example, the 30-year yield on a U.S. Treasury break above an 80-month moving average, a mega trend that has been established since 1981, 40 years. That's not something that has happened every year. That's not something that happens every day. That's something that's telling us something changed, something macro changed, and we're about to head into a period of higher inflation for longer. Now, that doesn't mean that inflation is just going to go straight to the moon. Of course, we're going to have fluctuations. It can come down. It's going to go back up again, but it'll probably remain uptrending, for the next several years, maybe even decades. Okay, because the bond market and inflationary trends tend to move in secular markets that can last 10, 20, 30, 40 years. Not necessarily 1 year to the next. Not necessarily because not necessarily because Powell raises rates and we bring a recession in the US means that we're going to have lower price increases, like we were seeing with China and other places, like we're seeing with, the world fragmenting, different things. So the higher inflation for longer narrative is very supportive for gold. And then this is very interesting, Jesse, talking about what's happening in Russia and Ukraine as well. These two systems that are being basically created, well, the US system and the Western system that already exists, and the one that's being created by, say Russia and, others. At some point when things start cooling, and these two systems are going to coexist. And what better arbitrage between the two systems than gold itself? How are you going to tell me what my rubles are if I'm not doing business with you? And how are you going to tell me what my dollars are worth if you're not doing business with me? That kind of thing, right? And so I believe that the arbiter for that situation is going to be gold, because gold has been traditionally the currency, of preference for over 5,000 years, and will most likely continue to do so in that capacity. It is no coincidence, Jesse, that last year was the year that central banks added most gold to their foreign reserves ever. Ever. That's not a coincidence. So
Right.
all those things are telling me that gold is going to become a bigger part of macroeconomics, about foreign reserves, a bigger part of determining valuations for currency, as an arbitrage between different systems, as a store of value in the time of inflation, especially what's coming down the line. So that's why I think that definitely gold is something that you want to hold, you want to buy. I think it's a perfect storm for gold. Unfortunately, Jesse, that a perfect storm for gold doesn't necessarily mean it's going to be a perfect storm for humanity or for society. It means higher prices. It means, like it could mean things that are calamitous. That's just a reality, and that's where we are in. Not that I want it to happen, but that's just where we're going.
So I want to get your thoughts on a couple of other commodities as well that I know you're bullish on, starting with silver. Now, silver also has not only the monetary side, but it's used in so much industrial applications. There's the whole new green economy being pushed, of which solar panels is a big part, of which silver is a big part of those. So how do you see the setup for silver at the moment, and how it's going to move up ahead?
I love silver, probably even more than gold right now. And for all those reasons that you said, not only silver is the poor man's gold. Okay. People throughout history that weren't able to afford an ounce of gold were able to afford an ounce of silver. Okay.
Yeah.
It's cheaper at everything. It was just an easier medium of exchange. So silver also will move, with gold as a store of value, as a safe haven, as currency. Okay. So I mean that in itself is bullish for silver. And then what you said, more and more, especially in this green revolution, silver is being used everywhere. And it's what's I cannot believe that the exploration cycles and production cycles that have been carried on thus far over the past 20 years contemplated such a big industrial need for silver like we're experiencing today and over the next 10 years. So I think that, we're going to have like we're going to have problems with supply. I think I think inventory is going to be an issue. I think that the world is not going to be able to produce. And this not only goes for silver, I think this goes for most of the metals and natural resources overall. But, like the reality is that there has been underinvestment over the past 10, 15 years in a lot of exploration and production cycles, and that in itself could lead to a shortage that could be very bullish for the price. So I do see silver rising substantially. If you want to look at price, I don't know if your viewers, are interested in price, but two big levels that I'm looking at, short term 24.50, longer term or intermediate term $27, $28. I think if 27, $28 is broken, I think silver could easily rise to the 2011 highs at $50 plus. I think that can definitely happen. The elements are there, like from the demand side, from the supply side, from what silver represents in the world. Now, the other elements, similar also, I'm very bullish also on uranium and natural gas. And, even though, natural gas especially has been taking a hit more recently, and like, and same with uranium. The reality is that if we are as a society going to push for green energy, and we want to reduce our reliance on fossil fuel energies, there is no other option than going through natural gas and uranium. Like, there is no way that we're able to. So imagine over the past 10 years or the past 10, 20 years, all of the incentives that have been given, for example, to solar, wind, renewable resource energies, all the space that has been created for this, type of energy to really come in and fill in this, supply need that we have. And it's not even 10% of global supply. And a lot of these production means need oil, like they're not 100% renewable resource. It's almost a lie. It's almost a lie that it doesn't create an impact. It's almost a lie that it doesn't need fossil fuels. It's just, so it's just not realistic. But that reality, that push created a big problem regarding the production of, all sorts of resources that now are going to be, fueling higher prices. But again, like, being that a push for green energy is really what people seem to want, and this world, like, not always what people want is what's right for them. But if people want it and the market wants it, most likely they're going to get it. And regardless of the cost, we see it all every day with all sorts of things. And again, the only way it's going to happen is if we start incorporating those elements. And you see, for example, that the United Nations recently labeled both of those energy sources as green energy. So the world is already paving the road for this to become the reality. It's a question of time.
Yeah, absolutely agree with you, especially in regards to nuclear energy. It seems that governments and countries around the world are embracing it as a clean source of energy. And there's only a few crazy outliers like Germany and Belgium, maybe Austria, I think, as well, who are actually pushing back. But the funny thing is, now they're the ones who look crazy. In the past, people like us were the ones people thought were crazy pushing for nuclear. And now it feels like the tables have turned. So that's a great thing. Well, thank you so much for joining us today, Omar. For those who want to hear more from you, could you tell us about Gold Charts or Us and anywhere else you'd like to direct people online?
Yes, absolutely. Thank you, Jesse, for the space. It's been great. So much to talk about all the time. Like, happy to do this anytime. Absolutely. So my website is www.goldchartsrus.net. Okay. Basically, we are a weekly trading service. So I analyze macro markets every week with charts, with different data, fundamentals, and then I provide, based on that macro view, my recommendations as to how do I fill up my portfolio and what I recommend people to fill up their portfolios with. And we do it one trade at a time. So I go, we go, we buy a little bit right now of so and so. We buy a little bit the next day, buy orders, sell orders, and we try to navigate through all of this. And it's very much an active managed account system. So like, you get a lot of information, you get a lot of charts, you get a lot of data. You ultimately make the decisions, the reader, but like, you go in with your eyes wide open.
That's great. Well, I'll put a link to that in the description below. Thank you once again for being on the channel and hope to continue the conversation and also hope to see you at next year's Vancouver Resource Investment Conference.
Absolutely. Same here, Jesse. Thank you.